Hello, good morning and welcome to ET Now's Buy Now, Sell Now with me, Varun Hiremath and Karunya Rao. Let's get a move on and take a look at what we have for you this morning as far as headlines are concerned. Beginning with the fact that the global handover was pretty decent, the Fed has held the fire, so to speak. Powell says economic activity is still below the pre-COVID levels though, but the Fed is going to be keeping the interest rate atmosphere pretty much steady, near zero, no changes there, and it's probably going to maintain its accommodative stance throughout the rest of this year as well. Karunya.
Right, but let's talk about what's happening back home. As far as D Street is concerned, markets are holding out very firmly. You have Nifty gaining close to 78, 80 odd points. Sensex is up close to 300 points. So good gains coming in as far as D Street is concerned. Early first half of the session is looking quite upbeat.
Right, Karunya, most definitely is. And you said pharma is doing well. Well, we have a pharma pick this morning. Dr. Reddy is in the back of that result yesterday, which saw decent revenue hold up and margin expansion. Much to everyone's surprise, today sees a host of upgrades, pouring in from brokers. So you have CITI, which has raised their revenue guidance now for FY21 and 22, and they've also raised their EBIT and EPS forecast by around 5 to 7%. So the target price based on this brokerage upgrade comes to around 5,000 rupees per share, giving it a 22 times 1 year forward EPS multiple.
Right, let's talk about some more gainers that are in focus on back of Q1 report card. You have Maruti in extremely top shape. JP Morgan says investors should now look beyond what happened in Q1. They've maintained overweight. The target that they have given, 67.50 rupees a share. Credit Suisse is also quite upbeat. They've also maintained an outperformance stance. The target that Credit Suisse is given is even higher, 7,009 rupees a piece.
Okay, and taking a look at aviation, something we haven't spoken about for a while on Buy Now, Sell Now, seems to be flying high today, and that's Interglobe Aviation. Indigo says that they expect the fare caps to be removed soon so they can start charging more. Strong demand has been seen in the first 20 days of July, and they say that the second wave of lockdown has definitely impacted their demand. So what they see is as Unlock 3.0 gathers more momentum, fixed cash burn should decline as their operations resume. And they're also in talks with OEMs about the lease costs for a lot of their aircraft. So that stock has been fairly buoyant today, and some good cues coming out of there this morning.
Meanwhile, Bharti Airtel in focus, they delivered their numbers last evening, and despite an overall okay set, they failed to infuse the markets. It's perhaps the extremely massive AGR provisioning that's hurting the investor sentiment, because the margins did see a healthy expansion. ARPUs have come in way higher as well. So this one is looking pretty quiet as of now, up by just about 0.3%.
Right, Karunya, Airtel's been rather quiet given that the numbers are pretty decent, and they're just really lagging behind Reliance. They really wonder why that is. But speaking of Reliance, their results are today, and it's going to be a key number to look out for. It could be a muted quarter for them given everything that's happened with crude. But the poll suggests that the COVID impact is likely to be higher on the refining and retail businesses. So that's for Reliance. In addition to that, we also have another index heavyweight, HDFC Limited, putting out its numbers today. We also have Tatacom, which has been on an absolute tear, circuit a couple days ago, and then very strong. That's also putting out numbers today, and we should look forward to all these earnings.
Absolutely. Let's talk about the developments that have taken place with regard to the pandemic, what's happening across the country and the globe. The global COVID cases have hit 17 million mark. COVID recoveries in India have crossed 10 lakh. Unlock 3.0, we've got some updates and SOP in place for that as well, which allows gyms to open, no night curfew in the month of August. Maharashtra, meanwhile, extends lockdown till 31st August, however, malls to resume. PM bats for lending to productive sectors. UP plans to create district panels to combat the virus. Government apps DGCI to ensure equal distribution of COVID drugs. Dr. Reddy's to launch drugs for COVID-19 in August. Brazil lifts air travel ban after a gap of 3 months. And China plans to lift travel ban soon as well.
Okay, thanks for that update, Karanya. Let's now go across to Jayesh because it's the end of the month. It's also expiry day, and we all want to know how the July series really shaped up. So Jayesh is going to walk us through that.
The July series has been dominated by the large cap stocks as well as large cap indices. But first, let's have a look at the market rollover picture as well. For the Nifty, it stands at about 58% as compared to 59% 3-month average. But for the Nifty Bank, it has been lower than what the long-term average has been. 50% is what we have rolled over as compared to 3-month average of 57%, which indicates that market participants are not too confident of carrying their positions into the August series as well. But like I was saying, that it has been a large cap dominated series because the Nifty IT index has outperformed all other sector indices with more than 20% return for this series itself, followed by the Nifty as well, nearly 9% gains for that one, and the auto and energy space also gaining more than 8% for this series itself. However, the mid and the small cap indices have underperformed. About 4 to 7% return is what they have generated. And you have the likes of the PSU Bank Index, Media, as well as the Real Estate Index, which have declined 5 to 7% each. The India VIX Index also, that has cooled off 19%, and it is on track for the fourth straight series loss that we've had. It has declined more than 70% from its 52-week high that it had hit in March 2020 as well. But on to the stock gainers and stock losers as well. The stock gainers primarily comprise of most of the IT stocks. You have Infosys topping the list, 36% return for that one. Coforge also giving you about 35% return, and you have HCL Tech and Wipro, which have also managed to give you more than 25% return for this series itself. The only non-IT name that features in the top 5 list is JSPL, more than 20% return for that as well. As far as the stock losers are concerned, you have a lot of high beta names, starting off with Z Entertainment and Vodafone Idea, which have given you double-digit negative return as well for this series. And you have Bharti Infratel along with Interglobe Aviation and L&T Finance, which has also managed to decline more than 10% each for this series itself. Also important to note that there are a couple of stocks that are being excluded from the August series as well, which is Just Dial and NCC.
All right, Jayesh, thanks much for that. Let's keep it with some more market views coming in. We caught up with market veteran Rhythm Desai of Morgan Stanley, who believes that this rally could turn out to be a ferocious bull market. Speaking to us, he said that it's time to buy any short-term dips in the market. Let's listen into an excerpt of the conversation.
The levels of stimulus are unprecedented in world history. We didn't get this type of stimulus either during the Great Depression or during World War II, or in the aftermath of World War II, or in fact, even after GFC. This size of stimulus has been unseen in living memory, or in fact, even beyond that. So this stimulus is going to find its way into asset prices and stock markets, and that's what we are seeing right now. And this is likely a ferocious bull market because eventually the stimulus will find its way into the economy, and the economy, we reckon, will be in a V-shaped recovery globally, even I think in India over the next several months. So that's what the market is.
Desai's word to ET Now yesterday, and he seemed quite upbeat on the markets in general. But let's get a move on. Both our experts are now with us. Good morning to Kunal and Vikas. Great having you on the show as always. Kunal, let's begin with you. There are a couple of factors to talk about today. It's expiry dates, the end of the July series. It's the results of the largest Nifty weight and some other key results as well. What's your call today? Which picks are looking interesting? And how's that chart looking, the Nifty chart looking to you this morning?
Good morning, Varun. First of all, it's a good start for the markets. I think after yesterday's drubbing of sorts, I think it seems to be now a better outlook for the market so far. But we need to see how the market will shape up. I think today's move is particularly led by a few large cap names, which is heartening to see, of course. I think Reliance, Kotak Bank, even Maruti is up 2.5%. So many of these stocks are now trying to provide the lending hand or helping hand. So it's a good sign that large cap stocks are participating, and I think in that regards the market should take a bit of comfort over there. But then since it's the expiry for the current month as well as the start of the press series, we look at the F&O data particularly, and this is some very interesting observation which I at least looked out for many of the stocks. So I think from the Nifty IT pack, from large cap names like Reliance, there has been a drastic and a dramatic drop in the open interest in last 1 week or 10 days. So the open interest for many of these IT stocks, Reliance, etc., mid of this month was completely on the higher side, and right now you've seen more of short covering. So when you see the price rally and when you see the open interest trend, it clearly indicates that there has been a short covering which is happening into these stocks. So going into the next expiry, going into the August expiry, the markets are going in very light in terms of the open interest for many of these stocks, whether it's Nifty IT, large cap names, or Reliance, etc. in this regards. So I think it's going to be interesting, expiry, interesting start of the fresh expiry, because on such open interest, lighter open interest, it's going to be difficult to anticipate, how the trends will shape up. So that's one point. In terms of individual stocks, I would recommend two buys over here. But the buys are, other than those three large cap names, I think in the first one, I believe is a Titan Industries. The stock looks very attractive to me on the charts because it's forming a classic bullish flag pattern on the daily time frame. It's heading towards a breakout about those 1055 mark on spot level. So it could be an interesting buy from current levels. Targets which have landed for Titan is approximately on that 1100 plus mark. Stop loss could be kept at 1020. The second stock is upon Mindtree. I discussed the stock in the morning show as well, and I believe that the stock is showing some extremely strong potential on the daily, weekly, and the monthly chart. So there are some slew of bigger price patterns getting broken out for Mindtree. So that also remains to be a buy. Revised my targets are to 1160, and stop loss could be kept at 1050.
Okay, so Titan and Mindtree on Kunal's radar. Let's move right on to Vikas Sethi for his fundamental wealth creation bets. Vikas, over to you. What are the stocks that you'd like to flag off?
Yeah, good morning, Karanya. Good morning, Varun. As far as the markets are concerned, they seem to be in fine fettle, although one needs to be cautious at these levels and should only look for quality. The two stocks which I would like to recommend today from a long-term point of view, the first one would be a KEC International. It's an RPG group company. It's one of India's leading EPC company in the power transmission distribution segment. The company also does a lot of work for railways, where the government is focused on, and a lot of spending is being done on railways. So that would be a major trigger for KEC International too. The company has a very strong order book of around 20,000 crores. The fundamentals are rock solid. It has a high return on equity of around 21%. And if you look at its last 5 years performance, the PAT has grown at a CAGR of 48% in the last 5 years. So at the current levels, the valuations also look reasonable. So I'm bullish on the stock at the current levels of around 220, 277, 280. And my target in a year's time would be 350 rupees on the stock. The second stock which I like at the current levels is Cochin Shipyard. It's a PSU stock, a great company. If you look at its March quarter results, they were pretty solid. Profits were up 44%. It also has a pretty strong order book of around 14,630 crores. They recently bagged a big order from Norway also. Fundamentals are again pretty good. The return on equity is around 17%. It's a zero debt company. The company declared a dividend of 16 rupees 60 paisa last year. So that works out to a dividend yield of around 5%. So at the current levels of 340 odd, the stock looks good, and I have a target of 415 a year's time.
Okay, great, Vikas. Thanks for that. Let's quickly, before we get on to our queries, just address the BNSN stock cloud for this morning. There's quite a lot of action going on there. So the producers will just pull it up in a second. We're going to begin the stock cloud this morning with DRL. I don't need to tell you why. Amazing earnings yesterday, margin expansion. The stock was up a solid 4 or 5% yesterday. I think that move has carried forward today, and it's been fairly upbeat. At least it was earlier on in the trading session. So that's why DRL's in there. Then you have a Maruti on the back of its results, which came out yesterday. As many expected, the results were a bit weak, but if you look at the counter today, it actually found some positive in early trade. So people obviously knew what was coming and they liked what they saw. Bharti Airtel, as Karunya mentioned earlier, again on the back of results, improving ARPU by 2 rupees to 157. EBITDA has seen some improvement, but there have been revenue pressures because of just what we've seen during lockdown. BPCL's in there because the privatization deadline has been extended to September 30th, so investors not too happy about that. TCS, Wipro are both in there because there's been a massive headcount cut at both these firms, and IT firms in general have seen a drop in headcount in the first quarter. Interglobe, again, we told you there's some good commentary coming out of there, and the stock was fairly active today. iShares on the back of everything that's happening in the HCV space. RIL is going to be putting out results today, so that needs no introduction. And finally, GSK Pharma, because their numbers were out yesterday. Stock's a bit down right now, so perhaps not too positive an outcome there. Karunya.
Right, let's kick off our viewer queries then. First up, we have an email from Namit Sharma. He writes to us from New Delhi. He's bought Colgate at 1411, wants to know whether he should continue holding on to it. The quantum of shares has not been mentioned. Okay, so Colgate Palmolive, Kunal, coming to you first. In the last, I think perhaps 2 months, May end is when the stock started moving up from 1200 odd levels right now to reach 1424. He has made money, I'm guessing, since his buying price was 1411, irrespective of how many shares he holds. How are the prospects looking like from the current level?
The stock has not done too much in last 3 months from, I think, May start or May beginning, start of the May series. The stock has remained absolutely sideways. So I think it's just about plateaued at the 200-day moving average. It just about takes supports and resistances and moves around this particular average. There's not been too much of a great move, and that generally defines how the FMCG stocks they tend to behave. There is a spurt for a couple of months where the stocks move up. Also in Colgate's case, I think from those March lows of 1100 approximately, the stock jumped up to 1500 in a matter of 1.5 odd month, and from there on it remains sideways. So they have to adjust to the sharp rise in the beta because of their nature of being more defensive in terms of sector moves. So I think in that regards, Colgate is a typical stock which is moving sideways. But I believe that if the stock is rising up higher and then consolidating at a higher end of the price range, those are considered to be strong indications that buyers are not out of the stock and they're still intact. So I think it's more of a patient trade. If you are looking to buy, or if you've already bought Colgate at current levels of maybe slightly lower levels, then I believe that you should hold on to the stock. If you're looking to buy, then I believe current levels could be an attractive buy. If you just want to time it slightly better, maybe a 1350, 1360 could be a better entry price for you on Colgate. But your time horizon has to be pretty medium term to long term, at least 6 months to 1 year, for you to get decent rewards and decent benefits from the stock price.
Okay, thank you, Kunal. Vikas, coming to you, Colgate numbers were out recently. What did you think of the numbers? And then based on that recent performance, what's your advice to investors?
Yeah, Varun, as far as Colgate is concerned, the numbers reported this quarter were pretty lower than what the streets were estimating, and that is what is being reflected in the price movement today. But it's a good quality stock, and since the investor wants to stay invested from a long-term point of view, I think he should continue to hold on to the stock. It's a great company, a good portfolio stock, and I think if he continues with the stock for next, say, 9 to 12 months, he could get decent upside from the current levels. I'm expecting at least a 20% return in the next 1 year on Colgate.
Okay. Vikas, just stay on with us. Let's begin the next query with you. RIL has been bought at 1340. And he's looking to sell. He just doesn't want to miss out, I guess, on any upside. And this is from Sunil Bajaj, who's written to us from Jabalpur. So given that results are around the corner and it's expected to be a muted or a weakish kind of quarter, what would your advice be?
I've also been recommending this stock since quite low levels. The stock has done tremendously well during the lockdown period. From levels of around 1150, that's come up to levels of around 2100 plus, and the investor needs to be complimented to have bought this stock at such lower levels and continue to hold on to the stock until now. And as far as the reply at the current levels is concerned, today we are talking on a day when Reliance is due to report its numbers. The numbers would be muted because its major businesses like oil and gas and retail would not do as well because of the lockdown. But telecom would do certainly well. But I continue to remain bullish on the stock if one has a 1.5 to 2 years point of view from here, because I feel all these businesses, the consumer businesses, namely the Reliance Retail and Reliance Jio, would do pretty well. And I feel in the next 1.5 to 2 years, they would be demerged, and tremendous value unlocking could result from that. But as far as his concern is there, since he's sitting on huge profits and wants to trade, then I think one can book some profits at the current levels. Partial profits could be recommended, and then he could look to re-enter the stock when it comes down. It would give opportunities on its journey towards new highs, but I think it's a great stock to remain invested in from 1.5 to 2 years point of view.
Okay, thanks for your view, Vikas. Kunal, what is your sense on RIL? Of course, the viewer has made good amount of money on his investments here, but will the momentum be as strong as it has been in the recent past?
I think first of all, congratulations to the viewer for buying the stock at an price. I think those 1300 levels were apt levels for the stock. It was more or less like a turnaround for the stock at those kind of levels. So he's bought at a perfect price and he's holding on to it. I think, and my answer to this question, Karnya, is not just to this viewer, but for many of the holders of Reliance Industries. What happens is when a stock rises up from 1200, 1300, it gives you 50% kind of returns in a very short span of time. Traders and investors, even though your initial view when you enter into the stock is long term, but the fact that you get such a good reward in a short span of time, you tend to be very fidgety in terms of booking out profits. But my sense is, if you're not in any kind of urgency, if there is not any liquidity issue, etc. for you, then I don't see any reason why you should be looking to exit Reliance Industries. I think the stock has been missed out by a lot of traders and investors, even by a lot of institutional funds as well. In the proportion in which the stock has moved up higher, they've not been able to buy the stock at current levels. So there's always going to be a demand which is going to chase the stock. As now you see the stock correcting, if there is any major correction which could pan out. So unless you are extremely bearish on the market or you are expecting the markets could crack very sharply, I don't see a reason why you should be looking to exit your holdings on Reliance Industries. I, for one, believe that the stock, such kind of a sharp uptick when you see into a stock price, it generally charters the stock into multi-years of uptrend. So, I, for one, believe that you should hold on to your investments on Reliance Industries. And the fact that you bought it at such lower level already gives you a lot of buffer and cushion to hold on to it for long term.
Okay, so it's a consensus thumbs up, a consensus hold call coming in on Reliance Industries. Let's address our third query for the day. Ravi Kumar of Jaipur writes to us. He's bought shares in ICICI Bank. Again, the quantum is not known, but the buying price was 376 rupees. Wants to know what are our experts' views over the near to medium term. Kunal, the stock has been largely range-bound in the last 3-4 months. Perhaps, on the higher side, on the minor highs that it's seen was close to 375, 380 levels. Do you believe this sort of a range-bound momentum to continue going forward, or do you believe any uptick could come by in the stock price?
Happening, Karnya, is that there seems to be now a certain concentration which is happening with the private sector bank names. So when you look at the price moves for the top quality private sector banks, so I'm talking about HDFC Bank, Kotak Bank, ICICI Bank, and maybe we can add to that an IndusInd or an Axis Bank in that regards. And there is some concentrated price action which is happening. I think the likes of HDFC Bank and Kotak Bank are seeing much more better traction, in terms of price and volume action, volume activity. There seems to be more strong and solid breakouts. There is that slight edge in terms of price performance. In both these names as compared to the other peers like an ICICI, etc. So my sense, if you are looking to buy something from the private banking space and looking at the current charts, I believe why not look at Kotak Bank or maybe HDFC Bank at current levels, provided your time horizon is slightly medium to long term. But if you are looking to anticipate that there could be some sort of a turnaround, then you can probably buy ICICI Bank as well. But my sense is that the waiting time over here for ICICI Bank to break out about those 370, 380 mark would be slight bit more higher as compared to the other players like Kotak Bank or HDFC Bank. So you have to try and pick and choose depending on your time frame, your risk appetite, and your goals. But I believe Kotak Bank and HDFC Bank in that order will probably try and outperform even an ICICI Bank from a short term.
Okay, that's interesting, Kunal. Vikas, let's come to you. You know, often when ICICI was at 550, people started to put it in the same club as a Kotak and an HDFC. Maybe not valuation-wise, but definitely it was, you know, trading fairly up there. Now, recently, there's been fundraising news in ICICI. There was also very good performance in the quarter gone by, but that stock just has not moved. So what's the reason that you're seeing this disparity more than even with like an Indocin, for example, which moved on fundraising and results?
Yeah, Varun, you rightly pointed out that ICICI has not been performing. If you look at the results which were declared by the bank recently, the results were pretty good. But despite that, the stock has underperformed, and that has mainly to do with the fundraising plans which the bank has. So they're planning to raise around 15,000 crores through a QIP. So the markets are waiting for the price at which that QIP would be done. But I think once that overhang is done, then I think the stock would move up. So it's a good time to even buy into ICICI Bank at the current levels. And since the investor has bought it at the higher levels, I think he should continue to hold on to the stock. I like the stock, and I feel in the next, say, 9 to 12 months, we could easily see levels of around 450 to 475 on the stock.
Okay, great. So Vikas is a little more upbeat on that than Kunal is. But with that, we've come to the end of our queries. So a big thank you to both of you, as always, for joining in. And we look forward to the next time you guys are on BNSN. I think it's also time for a quick break here. Plenty lined up. Do stay tuned.
Welcome back. You're still watching Buy Now, Sell Now. Before we proceed further, I would like to quickly thank all our viewers once again for choosing ET Now as their #1 destination for all things business news, markets update, corporate updates, and policy-related news as well. Thank you so much to our viewers once again for picking ET Now as their #1 favorite, most English news, business news channel. Okay, moving on then, quickly addressing some individual stock-related updates. Here out Indigo CEO Rangajoy Datta commenting on capacity utilization and positive outlook for the coming quarters. Here's what he said.
Many of you don't see the lease returns, the planned lease returns. And actually, the planned lease returns for this year are higher than the planned deliveries. So that in itself assures us that the capacity is balanced, and so that's one thing where we can, let's say, moderate the fleet growth or even keep it at balance. And another element which is not so seen very much in the actual figures, in the fleet numbers, is that we can use, for example, to a lesser degree, CEO aircraft, which enables us to optimize engine shop visits and bring the engine costs down. So there are many ways in, let's say, in adapting the fleet size and capacity size, which we are actively using. And one of our top projects is to get all this aircraft out, the lease returns in the phased manner and at the timelines as we have planned for.
Okay, so that was Indigo. Let's switch gears a little bit to Airtel, which just put out its numbers, and now we're going to walk you through the brokerage views on it, beginning with CITI. They maintain their buy with a target of 690 rupees per share. Q1 was an impressive performance despite challenges, and good performance indicates a robust biz of the company. So that's what CITI has to say. They also believe it will grow to benefit from its diversified revenue stream. Coming down to Macquarie, they also have a view, slightly more bullish target, 700 rupees. They maintain and outperform. They say that Airtel derives more than 75% of its revenue from consumer mobile, which they like. The June quarter mobile ARPU in India increased to 157, so that's a 2 rupee Q-on-Q increase. And the target price, like we said, is giving them an 11x FY22 EV to EBITDA multiple. So brokerages continue to seem quite upbeat on Airtel, and they have been for a while, but the stock seems to be lingering.
Okay, let's move right on and talk about some more earning candidates. Here out K. N. Radhakrishnan, he's the CEO of TVS Motors. He's positive on growth going forward. Rural uptick is something they're betting on big time. Let's listen in.
They're also seeing demand coming from the rural. Jupiter is also doing very well. So if I look at it, I think overall we are in a very good situation because this quarter we opened with very low levels of stock. Normally we give 30 to 35 days of stock. It is much lower. So the customer retails have been much higher than whatever we were able to produce and give it into the market. So this is definitely going to help us going forward. What support we need is, this lockdown we are not able to predict. So that's why I bring in the caution. And the positive thing is also monsoon is normal, reservoir levels are very good, MSP support whatever government has given, the sentiments in the rural are also positive. So these are going to support.
Okay, let's also get you the house views on Dr. Reddy's, post those numbers yesterday. And a robust earnings seems to have ignited a rally. CITI is the one which has the most prominent view or target on it. They maintain a buy and the target has been lifted to 5,000 rupees per share. Now the results are a big beat despite multiple challenges in the Q1 according to them. The revenues were mixed, they admit that, but the margins is where they really saw improvement, particularly on the gross margin. In accordance with that, they've now raised the revenue target and the EPS forecast by around 5 to 7%. And that target gives it a 22 times 1 year forward PE multiple. So quite expensive, but CITI thinks it should get there.
So we would have got some benefit out of the currency because compared to last year, the currency has moved quite favorably. And but sequentially also, if you see, the margin has increased. So it is not all about currency. It is to do with our product mix, some leverage that we get out of the manufacturing productivity. And also, there are quarter-to-quarter fluctuations on some of the things which impacts margin, whether it is some write-offs or, if some quality problem or some things are there. So particularly in this quarter, things have been good. So as a result of all of them, the margin is healthy at 56%. I do not agree to the term cost cutting. We do not try to cut cost. We always try to eliminate waste and improve productivity. And it's all about, analyzing the end-to-end process which creates value. And how do we optimize it? How do we become more lean, agile, make it much more simple, and then, improve the quality, improve safety, and all these has a bearing in terms of your overall cost. So not only, some of the cost which is directly the cost of revenue, but also costs which are, indirect. Everywhere we focus, where it is justified, definitely we would like to, encourage that kind of spend. But where we feel there is a need to improve, then we focus on it. The more you focus, then you get a better kind of result. That's what we have been trying to do over the last few years.
Let's move right on and talk about Maruti as well. It seems to be in top gear, up 3% for a heavyweight like Maruti. The stock is trading close to 6,400 levels. Let me highlight some house views coming in following the results. JP Morgan maintaining an overweight. Target given there is 6,750 rupees a share. For Maruti, they said investors should start looking beyond what happened in the quarter gone by. Demand recovery, market share gains. These are the key positives and key things that they will benefit from once the recovery starts kicking in meaningfully. The company is seeing more market share as well from changing industry landscape, given that even how the management flagged off that the inquiry for smaller cars, for cheaper cars, something that Maruti really stands for. That kind of a demand will benefit the company in a big way as well. Credit Suisse maintains outperform stance as well. Their target is higher. It's at 7,009 rupees a piece. Negatives were one-off. They said the positives are not one-off. Positives are for the long haul. Retaining their outperform rating, expecting demand drivers to remain intact. They expect Maruti to gain share, to improve margins as well. They've pushed up FY21 to 23 EPS estimates as well by 1 to 4%. So big brokerages giving thumbs up to Maruti. The long-term story remains intact, and that's why they're betting big. And that is why we're seeing such strong traction come by on the stock price as well.
Okay, thanks for that, Karanya. Maruti definitely in focus, but Reliance also in focus, and Ajay is now going to walk us through what to expect from the Q1 numbers, which will be out later today. Take it away, Ajay.
Well, the first quarter results of Reliance Industries are expected to be quite weak this time round, and understandably so. Many of the segments this quarter will come under pressure. The street would want to know what is the extent of pressure which is demonstrated in the numbers. Refining, we all know, is in kind of a downhill. Gross refining margins, we are expecting anywhere in the range of $6 to $7. Well, the Singapore refining margin this quarter even dipped to negative. But being a complex refinery and changes in the composition, Reliance is able to manage some amount of refining margins, also add some amount of inventory gains. So let's see how much pressure is displayed on refining side, but there will clear weakness is expected there. Even the petchem end of the business, on the one hand, demand shrunk because of the lockdown. They have because of being a refinery which is situated on the next to the coastline, they've tried to export a lot of output, but it will be interesting to see how much of that has been possible this time around. Petchem will be under pressure. The margins on the petchem will also likely be under pressure. Same lockdown impact will be visible as far as the retail end of the business is concerned because of store shutdowns. There was some activity seen on the online booking part, but that was more towards the end. The biggest pillar of the earnings this time actually would be Jio, which actually saw tailwinds not only in subscriber addition but also in usage. ARPUs are also expected to be healthy with an upward bias. And don't forget, there was also tariff hike which will start supporting their business. So Jio will be one of the biggest pillars this quarter, whereas all the other segments come under pressure, however temporary they might be. But cushioning of any blow in performance will be made up for by outperformance of operational outperformance from Jio. Commentary will be important, how each of the segments go from here on, because even on the O2C, oil to chemical part, they've been trying to mix the composition and trying to juice out better margins. O2C has better margins. What is the roadmap from here on the commodity end of the business? O2C as well, refining is the street would want to know. Retail is now the focus area of the street, both on the operations front and even on the possible stake sales and value unlocking front, which Mukesh Ambani has clearly said next couple of months they will take stock of what kind of partnerships can be struck on a retail end. So commentary over there will be important. Jio platform with the money coming in now, what's the kind of roadmap from here on? Integration on the e-commerce side is something analysts would want to know from the management. But still, whatever said and done, the way kind of stock has rallied a whole lot from the March lows, and there will be a weak result which street is also bracing for. It will be interesting to see how does the actual street reaction is to this weak and subdued quarter this time, because of big transactions and a lot of news flow. There have been a lot of out of
Well, big boy Reliance, all eyes on that one. How and what will be the commentary like? How will be the numbers, etc. But HDFC Limited, another heavyweight to look forward to for their Q1 report card. Soumya is here to tell us what to watch.
Well, HDFC Limited is all set to report its Q1 FY21 earnings. Taking a look at the 18-hour poll, we expect profit to degrow by about 22% on a YOY basis to nearly 2,495 odd crore rupees, while the net interest income would show an uptick of about 13.4% compared to last year to nearly 3,450 odd crore rupees. Well, owing to the kind of tough macro environment, we expect HDFC Limited to report a muted loan growth, which will be primarily driven by the individual loan segment. And in fact, this growth momentum would be below trend due to the kind of softer individual and corporate growth. As far as the margins is concerned, we expect them to be pretty much steady with a slight downward bias. Disbursements in April and in the first half of May were pretty much nil or minimal, but in our recent interaction with the management, they did mention that disbursements from May onwards had indicated some amount of uptick on a month-on-month basis. The company is also planning to raise close to about 14,000 crore in tranches to augment its capital base. Recently, the company had updated on their Q1 FY21 operational performance, and the profit on sale of investments for this quarter stands at about 1241 crore rupees versus 1895 crore in the previous year. Well, this profit on sale of investments is owing to their stake sale in HDFC Life. Recently, RBI had mandated the company to bring down its shareholding in the insurance arm to about 50% or lower. So in order to comply with those requirements, HDFC Limited had sold their part stake in HDFC Life, and their dividend income for Q1 stands at about 298 crore versus 1 crore, which is going to reflect in the profitability somewhere. Well, as far as the management comments are concerned, we are keenly watching out as to update on the collections, the kind of recoveries that the business is seeing, asset quality trends specifically on non-individual loans and moratorium book. What is the kind of demand that they're seeing? Also, recovery and uptick in the housing sales is something which is critical. And lastly, their outlook on growth, margin trajectory, and the kind of provisions that the company would take owing to the tough macro environment.
Thanks for that, Soumya. Another index heavyweight pulling out its number today, HDFC, and we'll be keenly looking out for that one. Let's take a quick break here on Buy Now, Sell Now. We'll be back shortly.